In 1 week, in March 2020, the largest investment-grade corporate bond fund in the world closed at a 5% discount to the value of the bonds it held. 5%. On paper, that is free money. Buy the fund, hand it back, take the bonds, pocket the difference. An entire industry exists to do exactly that trade. For several days, they did not. The machine that keeps every exchange-traded fund honest simply stopped. That gap matters because exchange-traded funds are now the plumbing of modern investing. As of 2020, they managed about $7 trillion globally. Bond funds alone held more than $1.2 trillion, up from less than $10 billion in 2009. Every one of those funds makes an implicit promise. The price you pay on screen will track the value of what the fund actually owns. Nothing enforces that promise directly. No law requires it. No regulator sets the price. Instead, the promise is kept by a small group of firms called authorized participants, who profit by closing any gap that opens. Usually only 3 to 5 of them are active in a given fund. When they work, the price tracks. Here is the first thing worth knowing. For bond funds, the thing those firms hand over is not the thing the fund owns. That single mismatch explains almost everything that happened in March 2020. Start with where this machine came from. The first exchange-traded fund launched in 1993, and it tracked the S&P 500. Stocks were the natural home for the idea. A stock fund can hold every share in its index and hand over every share in that index, because shares are easy to buy, easy to sell, and you can trade a tiny fraction of one. Bonds are different in 3 ways that turn out to matter enormously. First, bonds are illiquid. They trade over the counter, dealer to dealer, and many simply do not trade on a given day. Second, the minimum trade size is enormous. Bonds typically trade in blocks above $100,000. A share can be bought for a few dollars or less. Third, bonds mature and shares do not, so a bond fund must constantly replace what is rolling off. Now put those 3 facts together. A fund tracking an index of thousands of bonds cannot realistically hand over all of them, so it hands over a sample, and that sample is chosen day by day by the fund and the firms it deals with. For the largest bond fund in the world, the sample represents about 3% of what the fund actually holds. 3%. For a stock fund, the equivalent figure is close to 100%. So the question that opens everything up is this: if the basket you can trade is not the portfolio the fund owns, what exactly are you arbitraging? Here is the mechanism, 1 block at a time. Block 1. The fairy. Imagine a fund holding 3 bonds worth $2, $3, and $5. The fund is worth $10. Suppose its shares trade at 11. An authorized participant buys the 3 bonds for 10, hands them to the fund, receives 1 new share, and sells it for $1 of profit, and the act of doing it pushes the share price down and the bond prices up. The gap closes itself. Run it backwards for a discount. Buy the cheap share at 9, hand it back, receive $10 of bonds, keep $1. That is the entire engine. It is not charity and it is not regulation. It is self-interest, and it is normally relentless. Block 2. Why bonds break it? Go back to our 3 bonds. Now say bond A is hard to find. Say they all trade only in blocks of 20. Say bond B matures next month. Suddenly the fund cannot simply hand over 1 of each. It may hand over 20 of A, 20 of B, and none of C. The basket and the portfolio have come apart. And the data says this is not a hypothetical. For funds holding United States corporate bonds, creation baskets cover only about 20% of holdings. Redemption baskets about 35%. For the largest bond fund, 3%. For stock funds, near 100%. Block 3. Now the consequence, and it is the part almost nobody says out loud. If you buy a share at a discount and hand it back, you do not receive the portfolio. You receive whatever the fund decides to put in the basket that day. And the fund chooses. Under redemption pressure, it can fill that basket with its least liquid, riskiest bonds. So the arbitrager is not buying a certain thing at a discount. He is buying an uncertain thing at a discount. And uncertainty has a price. Measure the friction and it shows up immediately. The bid-ask spread on the bonds a bond fund holds is about 17 times the spread on the fund's own shares. For stock funds, that ratio is 5. For high-yield bonds, the illiquidity measure averages 75, and in the COVID panic it reached 130. So the arbitrager faces a wide spread, an uncertain basket, and a market where the bonds he needs may not trade at all. At some point, a 5% gap is simply not worth it. That is not a market failure. That is the machine working as designed, and the design has a limit. Which raises the obvious question: if the gap does not close, who eats it? March 2020 answered it. As the panic hit, corporate bonds stopped trading in any normal sense. The authorized participants, who are mostly the same firms that make markets in those bonds, had no appetite to take more of them onto their books. So the discount opened, and it stayed open. The largest investment-grade corporate bond fund closed the week to the 20th of March at a 5% discount. Tracking error. The gap between a fund's return and its index blew out above 200 basis points for some funds. The long-run average for the sector is 0.7 of a basis point. That is not a drift. That is a machine stalling. Then the Federal Reserve announced it would buy corporate bonds, including through these very funds. The discount did not just close. It flipped. The same fund went to a 3.2% premium. So who actually got hurt? Not the authorized participants. They stood back, which is exactly what a rational profit seeker does when a trade stops paying. The people who took the loss were the investors who sold in that window at 5% below what their bonds were arguably worth, because the screen said that was the price. And here's the twist that makes this genuinely interesting rather than just a horror story. Some economists argue the discount was not the machine failing. It was the machine protecting the people who stayed. Think about what a discount does. If a fund is redeeming its worst bonds to whoever runs for the exit, the people who stay are left holding a better portfolio. The discount is the price of leaving, and a price on leaving is exactly what stops a run. That is the argument, and it is the opposite of the panic reading. So here is the lens. A stock fund and a bond fund look identical on your screen. They are not the same machine. One can hand over its portfolio. The other can only hand over a sample of it, chosen by someone else on the day you most want to sell. Most of the time that distinction is invisible and costs you nothing. In the moments it matters, it is the whole story. It does not tell you what to do. It tells you what you actually own. The forward question. The Federal Reserve closed that gap in 2020 by becoming a buyer. What closes it next time? If you want more breakdowns of the machinery under the market, this is what this channel does.